In this quick guide to audits and annual reports in Denmark, we will walk through the essentials you need to understand if you operate a Danish company or are considering establishing one. Denmark has a highly transparent and well-structured financial reporting environment designed to protect stakeholders, ensure trust in the market, and support sound decision-making. At the centre of this environment are two core elements: the annual report, which summarises a company's financial position and performance, and the audit, which provides independent assurance on the reliability of that information. First, let's look at the annual report itself. In Denmark, most companies are required to prepare an annual report in accordance with the Danish Financial Statements Act, also known as Årsregnskabsloven. The level of detail and requirements depend on the company's size and classification, ranging from very small entities in reporting Class A, which have limited obligations, to large and listed companies in Classes C and D, which face more extensive requirements. A standard Danish annual report will include a management statement, a management review, financial statements such as the income statement, balance sheet and cash flow statement, as well as notes that explain accounting policies and provide additional disclosures. Larger companies must also include elements such as a statement on corporate governance, information on risk management, and in many cases a report on corporate social responsibility and sustainability-related matters. The objective is not only to meet formal compliance requirements, but to give shareholders, lenders, employees, and other stakeholders a clear, consistent and comparable view of the company's performance and risks. Timing is another critical aspect. Danish companies generally must file their annual report with the Danish Business Authority within a specific deadline after the end of the financial year, often within 5 months for most entities and shorter for listed companies. Missing these deadlines can lead to fines and, in severe or repeated cases, compulsory dissolution of the company. So building a disciplined internal reporting calendar is essential. Now, turning to audits, the key question many companies ask is whether they actually need a statutory audit. In Denmark, the requirement for an audit depends largely on company size and legal form. Larger limited liability companies, public companies, and certain other entity types are required to have their annual financial statements audited by a state-authorized or registered public accountant. However, smaller private limited companies known as APS may be able to opt out of the audit requirement if they remain below defined thresholds for net turnover, balance sheet total, and average number of employees for 2 consecutive financial years. These thresholds are adjusted over time, but the principle remains. The smaller and less complex the company, the more likely it is that an audit can be deselected, subject to shareholder approval and the company's articles of association. Even when a full audit is not required, some companies choose to engage auditors for voluntary assurance, such as a review engagement, which is less extensive but still provides a level of comfort to banks and investors. Understanding what an audit entails is important. In Denmark, auditors follow professional standards and ethical rules that require independence, objectivity, and rigorous documentation. During an audit, the auditor assesses whether the annual report, including the financial statements, gives a true and fair view in accordance with the applicable financial reporting framework. This involves evaluating internal controls, performing analytical procedures, testing transactions and balances, and reviewing key estimates and judgments made by management. At the end of the process, the auditor issues an auditor's report, which is included in the annual report. This report states the auditor's opinion, either unmodified, meaning the accounts are presented fairly in all material respects, or modified, if there are significant issues such as material misstatements or scope limitations. For stakeholders, the wording of the auditor's opinion is a crucial signal about the reliability of the information presented. For management and boards, the audit also serves as an opportunity to receive insights on process improvements, risk management, and internal control enhancements. The relationship between management, the board of directors, and the auditor is therefore more than a compliance exercise. It is part of a broader governance framework. In Denmark, the board is ultimately responsible for ensuring that the annual report is prepared and that, where required, an audit is conducted. Boards typically work through an audit committee or similar structure in larger companies, overseeing the financial reporting process, the effectiveness of internal controls, and the independence of the auditor. For companies with international stakeholders, another common consideration is the alignment of Danish reporting with international standards, such as IFRS. Listed companies in Denmark are required to use IFRS for their consolidated financial statements, while non-listed companies may use Danish GAAP under the Financial Statements Act or choose IFRS for specific purposes. The choice can affect comparability, investor perception, and internal complexity, so it should be made with a clear understanding of the strategic implications. For smaller entities, staying with Danish GAAP often strikes the right balance between simplicity and transparency. From a practical standpoint, what should you do if you are responsible for a Danish company's reporting? First, clarify your company's classification, size, and legal form to determine your exact obligations regarding annual reports and audits. Next, establish a clear timetable that includes closing the books, preparing the financial statements, coordinating with the auditor if applicable, securing board and shareholder approval, and meeting the filing deadlines with the Danish Business Authority. Ensure your accounting policies are documented and consistently applied, and keep an eye on changes in Danish legislation or EU directives that may introduce new requirements, especially in areas such as sustainability reporting and ESG disclosures, where expectations are evolving rapidly. Finally, consider the broader value of high-quality reporting. In Denmark's trust-based business environment, transparent and reliable annual reports, supported by robust audits where required, can strengthen your company's credibility with banks, investors, partners, and regulators. Even if you qualify to opt out of an audit, assess whether some level of external assurance could support your strategic objectives, particularly if you are seeking financing or planning for growth. By understanding the rules, organizing your processes, and viewing reporting and audit not just as a cost, but as an investment in governance and stakeholder confidence, you can navigate the Danish framework efficiently and position your company for long-term success.